In this video, I'm going to show you how you can make $10,000 or more using one of my favorite strategies for safe and consistent income, the wheel strategy. So whether you're looking to supplement your current income or retire early, you're in the right place. We will be using Palantir as an example today, but you can run the wheel strategy on any stock that has solid fundamentals and future growth potential. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world and are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. With that said, let's get started. For those of you not familiar with Palantir, Palantir builds software that helps organizations, both private and public, make better use of data. They create platforms that allow users to integrate, analyze, and manage vast amounts of information, enabling them to make more informed decisions and improve their operations using AI. Next, let's go over to Yahoo Finance and check out Palantir's fundamentals. Looking at the 1 year chart, it's up 401%, which is absolutely insane. It made a 52-week high of 148.21 just recently and is currently trading around the $143 level. Looking at its PE ratio, it trades with a PE ratio of almost 620 right now, which is absolutely crazy. But looking at the rest of the fundamentals that I look out for when running the wheel strategy on a stock, it checks off all boxes. It's been beating earnings per share quarter over quarter. Revenue and earnings have been increasing steadily. At the end of the day, I would run the wheel strategy on a stock that I believe in long term. So that's what I would advise you do the same. Do your own due diligence and run the wheel strategy on a stock that you believe has strong fundamentals and future growth opportunity. So let's talk about the wheel strategy next. But before we do that, a quick disclaimer that this video is for informational and educational purposes only and should not be considered financial advice. I'm not a licensed financial advisor and simply showing you my trades and how I trade. So with that said, let's check out this diagram and understand how the wheel strategy works. So with the first step of the wheel strategy, you sell put options on your favorite stock for a set time, which is the expiration date, and you also choose a strike price to sell your put options. If at expiration, the price of the stock stays above that strike price, you get to pocket that entire premium. But if at expiration, the price of the stock drops below the strike price of your sold put, you get assigned. So with one options contract, you will get assigned 100 shares at the strike price that you sold the put option. Now, once those shares are assigned to you, you can then begin to sell covered calls on those shares at a higher strike price and collect additional premium. Now let's do an example with Apple. Let's say Apple's trading at $200 and you sell the $190 put. If at expiration, Apple stays above the $190 strike price, you get to pocket that entire premium. But if at expiration, Apple drops below $190, then you are still on the hook to buy Apple at $190. So in case you are assigned at $190 and Apple actually does drop to that lower price, you would wait for the price of Apple to come back to your cost basis, which is the $190 strike price, and then start selling covered calls on the Apple stock at a higher strike price. So assuming you got assigned at $190, you would then start selling covered calls at a price of your choosing. So let's say you start selling covered calls at the $195 strike price and start collecting weekly premium doing that. Now, if the price of the Apple stock goes higher than the $195 strike price covered call that you sold, in that case, you will have to give up your shares at the $195 strike price, but you collect additional profit from the stock price appreciation, which is the $5 difference between the $109 strike price and the $195 strike price. So running the wheel strategy, you can make profit three ways. First, by selling put options. Second, by selling covered calls. And finally, from the stock price appreciation when your shares are called away. Some risk management tips that I follow when running the wheel strategy. When selling put options, if the price of the stock drops below your sold put strike price at expiration and you're not ready to accept assignment for whatever reason, you can roll your position down and out to a further date to avoid assignment. Now, in case you don't know what rolling is or how it works, I'm going to link a video right here so you can check it out at your own convenience. Secondly, I mentioned this before earlier in the video, but you only want to run the wheel strategy on stocks that have strong fundamentals. In case the price of the stock drops below your sold put, then there are higher chances of the price to come back up quickly if that stock is a solid stock. You do not want to run the wheel strategy on meme stocks or stocks that have weak fundamentals, because obviously you're going to collect a higher premium, but eventually you're going to be bag holding the stock for a long period of time and your money is going to be blocked, and we don't want that. And last but not least, when selling covered calls, you want to choose a strike price that you're comfortable getting rid of your shares. So now that you understand how the wheel strategy works, let's go over to Palantir and see how we're going to be able to make $10,000 a month running the wheel on Palantir. I have Palantir's 6-month chart pulled up here on Thinkorswim. And looking at where Palantir is currently, it's around the 142 level. So it's in between the top and the middle of the Bollinger Band. So I'm going to look at some levels of support that I'm comfortable getting assigned or owning the stock. So the obvious next level of support is the 138 level, which is just about $4 lower than the current price. I want to play it safe. And if I'm going to go out a week and sell put options, I'm going to go a little lower than the middle of this Bollinger Band. And if I see right here, I have some support at the 134 level, and then further down at the 131 level. And then obviously we have the bottom of the Bollinger at the $130 level. So let's pull up the options chain and see which strike price would make sense to sell put options on. I'm going to go out a week to the July 18th, and then I'm recording this after hours Thursday, July 10th. Looking at the strike prices, I generally like to target a delta anywhere between 15 and 20. And for those of you who are not familiar with what a delta is and how it functions, in simple words, all that means is that if I go with a 15 delta, there is a 15% chance of the stock getting to that price point. And if I choose a 20 delta, that just means that there's a 20% chance of the stock getting to that strike price. Now, obviously, with a higher strike price, there is higher risk. So you are compensated for the higher risk with a better premium. And the lower you go on the delta, the less chances of being assigned. And thus, the premium's not as great as a higher strike price. So looking at some support levels, I said that there's some support at the 134 level, which right now is a 19 delta. There's also the 133 strike price, which is a 16 delta. And then we have the 135 strike price, which is a 21 delta. So given that Palantir is currently trading around 142, I'd be comfortable owning Palantir at this 134 level. And right now, this is offering us a premium of $1, meaning 1 times 100 shares. That's basically $100 because one options contract lets you control 100 shares. So I'm going to go ahead and select this options contract right here. And we want to make sure you click on the bid, because when you select the bid, then the order ticket by itself loads up a sell order because we're selling put options. I'm showing you how to get to that $10,000 monthly income that we're targeting in this video. And for that, I'm going to go ahead and load 14 contracts. And when I load 14 contracts and go with a bid price of $1, meaning $100 per options contract, so we're going to hit review. And as you can see, we're going to collect $1,400 doing this strategy each week. So let me pull up the calculator. So that's just $1,400 that you're going to collect selling put options each week. You times it by 4 weeks, that's going to give you $5,600 in monthly income just selling puts. Now let's assume that you actually do get assigned at that 134 strike price. And in that case, you can now begin to sell covered calls on Palantir. So just like put options, when I sell covered calls, I like to target a delta anywhere from 15 to 20. But the most important thing that I like to consider when selling covered calls is choosing a strike price that I'm comfortable letting go of my shares. So keeping that into consideration, I would choose a strike price that works for you. So looking at the same options chain right now, going out a week, if we look at a 16 delta, it's offering us a premium of 83 cents on the covered calls, or the next delta right after that is a 22 delta. And then that would mean that based on the current price of the stock, that's about $9 higher than the current price of the stock. And the 16 delta is about $10 higher than the current price of the stock. So assuming we go with the 16 delta, we would collect a premium of 83 cents or $83 per options contract, selling the covered calls. And then again, I'm doing the same thing. We're going to sell 14 contracts. And if I hit review, I'm going to collect an additional premium of 1162. So take that 1162 and do it times 4 weeks. So now we get to a total of 4648. That's additional income that we would collect by selling covered calls. So we sold put options for 4 weeks, and then for the next 4 weeks, let's assume that we sold covered calls and collected an additional income of 4648. Now let's say you sell covered calls one more time, and then this time your call options are exercised, meaning the price of Palantir goes above the strike price of your sold covered calls. And in that case, your shares are going to be called away and you will capture the profit from the stock price appreciation. Now, looking at the 16 delta that we went with, it's about $10 higher than the current price of the stock. So staying consistent with that logic, we had 14 contracts, meaning 1,400 shares. And if I assume that I get a price appreciation of $10 when my shares are called away, that's an additional income of $14,000. Now, I'm a numbers guy and I like to put everything on a spreadsheet so it makes it easy for me to understand. And that's exactly what I did right here. So this is the entire wheel strategy and the total income that we would collect. So with the first step, we sold 14 contracts of cash secured puts, and that would require a collateral of almost 188K. Now keep in mind that you can adjust this based on the size of your account. So not to worry. But since in this video, I'm showing you how to make $10,000 a month, this is how much collateral it would require to sell put options, or basically 14 contracts on Palantir. Now that we have that out of the way, we're going to collect a weekly premium of $1,400, selling 14 contracts, and that would result in a monthly income of $5,600. And then once we get assigned and we sell covered calls, 14 contracts would yield a weekly premium of $1,162, resulting in a monthly income of $4,648. We said earlier that if we go with the 16 delta, that's about 10 strike prices higher than the current price of the stock. So keeping that same logic, I'm going to take the $10 stock price appreciation times 1,400 shares, which is the 14 contracts times 100 shares per options contract, would result in an additional income of $14,000. And then adding all three of these together is a total of about $24,000. So now you can just divide the $24,000 by 2 months, or it took us an extra week. So again, you get the idea. That should get you closer to the $10,000 target that we're targeting in monthly income running the wheel strategy on Palantir. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.